Welcome back to Economic Outlook. Today we're going to continue our discussion of commodities by examining their recent rise in price. First, we'll look at why commodities are attracting increased investment, and in our next discussion, we'll look at exactly how money is flowing into the commodity sector. Every 20 to 30 years, commodities enjoy a bull market cycle. So let's look at how a typical cycle functions. Commodity cycles begin when a surplus in supply creates low prices. This means producers can't charge as much for their raw materials, so they don't have as much capital to invest in infrastructure. Without the investment in infrastructure, the supply of raw materials doesn't keep pace with economic growth. As economies grow, they demand more and more raw goods, so the prices for the goods that are available will rise as the demand outpaces the supply. Eventually, these higher prices will attract capital investment. However, it takes time for the results of these investments to materialize, so prices will continue to increase. Eventually, the increased investment will allow supply to meet demand, and the price of the commodity will level off. And then the cycle begins again the next time there's a surplus in supply. The last boom in commodity prices occurred in the early 1970s, when global instability and supply concerns caused energy prices to soar. We recently saw commodities hit all-time low levels at the end of the dot-com bubble in late 2000 and early 2001. At the same time as commodity prices were hitting all-time record lows, the global economy was prospering. This led to increased demand for raw materials in emerging economies like China and India. Eventually, the supply of raw materials wasn't able to keep pace with the demand, and we saw prices begin to rise, as we see in this chart. Here we can see wheat, copper, and crude oil compared to the S&P index. Since January of 1998, all three commodities have increased at far greater rates than the S&P. These price increases have intensified since 2005, and we're currently in a period of high prices and supply shortages. This means that as the price of commodities go up, producers are able to sell their raw materials at multiples many times greater than they were just a few years ago. This next chart will show a few examples. As we can see here, commodities in several different areas are trading at multiples up to 6 times what they were in January 2002. Commodities as diverse as coffee, wheat, nickel, gold, and crude oil are all trading at levels far greater than they were in January of 2002. When you compare these multiples to the financial indices and the S&P sectors you see in the chart, it's clear to see just how much commodity prices have increased since January of 2002. When commodities trade at multiples this large, it means that commodity firms have adequate capital to invest in infrastructure. Theoretically, these companies will invest the proceeds from the sale of their raw materials and increase the supply of the goods. Theoretically, this will balance out supply and demand over the long term. Other economic factors have helped to accelerate commodities price increases. First of all, after the dot-com bubble burst in 2001, investors sought returns and feared inflation. Commodities are a natural hedge against inflation because as inflation rises, commodity prices usually go up as well. Therefore, institutional investors and retail investors began to look at commodities as more of an asset class. As investors looked for alternatives to equities and bonds, they discovered that commodities could be valuable assets for portfolio diversification. Diversification is important because it allows the portfolio manager to increase the expected return for his portfolio while holding risk steady or even reducing it. Portfolio managers discovered that commodities had low or in some cases negative correlation to equities. Portfolio managers are especially excited about negative correlations because they allow him to create portfolios with higher returns while reducing the level of risk of the overall portfolio. When you couple this with commodities' rapid price increases, it's easy to see why they quickly became attractive to institutional investors like pension funds and insurance companies. Our next chart shows the correlation coefficients between several commodities and our major financial indices like the Dow Jones and S&P 500. To understand this chart, let's look at one example. Under the meats category, beef has had a correlation coefficient of 0.62 with the Dow Jones Industrial Average since 1998. However, as we narrow the time frame to more recent years, we see the correlation coefficient decline. Since 2005, beef has had a correlation of 0.00 with the Dow Jones, and since 2007, its price has had a correlation coefficient of negative 0.31. This means that beef prices have increased while the Dow Jones has either held steady or decreased. This is very important for portfolio managers because they can use commodities like beef, sugar, or oil to diversify their portfolios and protect against declines in the Dow Jones, NASDAQ, or S&P 500. As you can see, many commodities in this chart follow the same pattern as beef, with correlation coefficients becoming smaller and turning negative in more recent years. This chart shows how the correlation coefficients for several metals have changed over time. In this example, we look at the correlation between the price of these metals and the S&P 500 index. In all 5 cases, the correlation coefficients have become negative since 2007. This has clear advantages for portfolio managers looking to diversify their portfolios. Energy prices have also received much scrutiny in recent months. Let's look at how their correlation coefficients have changed relative to the S&P 500. As we can see in this chart, the correlation coefficients for natural gas, crude oil, gasoline, and jet fuel have all declined relative to the S&P 500. This means that portfolio managers are more likely to invest in energy to diversify their portfolios of S&P 500 stocks.